Today, we'll look at what is called cost of capital. Cost of capital. So we firstly need to understand what we mean by the term cost of capital. In simple terms, our cost of capital is simply the average rate of return that a firm must pay its investors for using their money. In the preamble, I mentioned to say that there are different sources of financing that a firm may have, emanating from debt, through equity, and also using retained earnings. So instead of borrowing, managers would want to use the profits that were supposed to be designated for dividends. But there's a cost of using that. Of course, could be less than them borrowing. And that's why this cost has been introduced, cost of capital. In other words, the cost of capital is the required return that investors expect when they provide funds to the company. So here the key point is that the cost of capital depends mostly on how money is used in terms of the assets, not where the money comes from that is financing. So it is important for us to understand this because if you invest in a risky project that will give you high returns, of course, the investors would also want to have what? A, a copy from it. So we introduce the cost of capital, why it's important, and the components of what we call the cost structure, which we have, including debt, preferred stock, and common stock. So collectively, we will call this. We'll also look at what is called weighted average cost of capital. So the cost of capital reflects the funds or the average funds for the firm required by the investors for using their what? Their money. So the concept cost of capital. So let me give you a concrete example so that you could at least understand what I'm talking about. So say if a firm may say the cost of capital is 12%. So here's what they mean, that a project will only have number one, a positive NPV if the return will exceed 12%. And the firm will earn at least 12% just to compensate the investors for the risk that they are taking. Critically thinking or analyzing this, the project must earn 12% or more. All right. So if we say our cost of capital is 12%, so we have 100,000, whatever you're going to use our money for, instead of you going to banks that will charge you 30% interest, our cost of this capital we're giving you is a return that will not exceed 12%. So remember, cost of capital is tied to the use of funds, not just the source. So why is cost of capital important, and why must managers care so much about it? Here's the reason. Importance of cost of capital is as follows. Number one, firstly, it is essential for capital budgeting decisions. So you can't decide whether to invest in a new factory or machine without knowing your cost. You need to calculate your cost. Even discipleship in the Christian world, for you to become a disciple, a follower of Christ, you must count your cost. The Bible actually talks about the cost of what? Discipleship. There's a cost. You must calculate what you need to forego, opportunity cost. Secondly, it will also help in designing the company's capital structure. You need to know how much debt and how much equity you need to use, depending on what kind of business you're in. If you need liquid funds every now and then, maybe equity may not be the best, debt may be the best. So there are questions that have scenario situations where you need to decide which capital structure you need to decide on based on the type of business. Thirdly, it will also help guide on decisions about methods of financing. So, should you issue bonds? Should you sell stock? Or should you use retained earnings? So, cost of capital is going to guide you on that. Fourth, it is also a measure of the top management's performance. So, a lower cost of capital will actually mean there's better financial management. And finally, it will also affect other areas like what? The dividend policy and working capital management. Any questions at this point? Are we clear? So I played with you. This is very important before we even go to the calculations. Now, we also want to look at the capital structure. This is where cost of capital becomes to life. Capital structure. What are we talking about when it comes to capital structure? So capital structure is a form of capital that a firm uses in financing the business. So we call that capital structure. So a company may only use one type of capital, say they would want to use common stock or a combination of different capital. So capital structure is simply the mix of these different uh, forms of capital. You can use preferred stock, debt, equity. So think of it this way. The goal of the manager is to do what? To increase the size of the pie or the total value of the firm. So the capital structure decision will be how you slice the pie. So if you slice the pie um, in a way that would affect um, y- your decision, so you need to really understand how to go about it. So in other words, choosing the right mix of debt and equity can increase or decrease the firm's value. So now there are different types of um, long-term capital. So we'll look at these different types of capital structure. We have long-term debt. We have debentures. So you could have a debt, yeah, you could have a mix of this. So the types of long-term capital that firms use include the following. We have what we call long-term debt, which may include bonds, loans, debentures. We have preferred stock. We also have common stock, which we call equity, which includes common stock plus retained earnings. Now let's look at each one of these costs because they're not the same, and we'll look at how to evaluate each of them. So there's what is called the cost of debt, long-term debt. So this is the structure. Let's look at the cost of debt. So this is money borrowed and provided by the lender in exchange for interest. So the interest is paid at a given rate. Since interest is an expense, uh, interestingly, accountants realize that companies are charged in their income statement. So there's what is called a tax shield that is removed here, one minus tax. So this is where it becomes interesting. So cost of debt is borrowed money, and the cost of this borrowed money is an interest rate that the firm will pay. However, this interest expense is tax deductible, so it creates this so-called tax shield. So the government efficiently pays part of this interest, and therefore the after cost tax is given by the KD 1 minus T. So if, for instance, you have a cost of debt of 10% and the tax rate is 40%, so your cost of debt will be 10% times 1 minus 0.4, which is 6% after tax. So notice how the cost drops from 10% to 6%. So that's a major advantage that debt financing may have. Okay. So this is an advantage that you're going to have. So if you have this example, for instance, cost of debt is 10% and the tax rate is 40%. So when you calculate that, 1 minus 0.4 gets 6%. So this reduction is an advantage. So we now look at preferred stock. What is preferred stock? Cost of preferred stock. So we have preference shareholders, like we discussed. These ones are paid earlier. They have a fixed dividend. They have a stated percentage. They are paid, unlike the ordinary shareholders, first. but they have no tax shield. So the formula is simply the dividend paid over the cost of the preferred stock or required rate of return. So dividend paid over the price per share. So let's just look at an example here. Preferred stock just paid 11.7 and sells for 100. What is the cost of preferred stock? So it's a dividend paid 11.7 quarter over the selling price or the price of a share, which is 100. We get 11.7%. Then we also go to the cost of equity, where it becomes interesting. So equity, we have what we call the ordinary shareholders, who are the real owners of the business, who have deciding powers, voting rights. So these ones are expected to earn what is called capital gain. So their formula is given as follows. We have two methods that we use. There's what we call the CAPE model, and we have what we call the dividend growth model. CAPE model is given by risk-free rate plus the market premium times the beta. Expected market return, that is the RM minus the risk-free rate, gives us what we call the risk premium. So this is the most expensive but most flexible. So equity holders or investors will expect two types of returns, the dividends and the capital gains, which is simply the increase in the share price. So we calculate them using what? Those formulas, the risk-free rate plus expected market return times risk-free rate times beta. So, and the other one is the dividend model or the Gordon's model, which is given by that formula. So these formulas, you need to know them. So this is also called the Gordon's model. So let's look at this example here. Suppose for a stock, the risk-free rate is what? 8%, the expected market return is 14%, and the stock beta is 0.7. So finding the cost of stock is risk-free rate 8% plus market return 14 minus 8% times the beta, which is 0.7. So here we get 12.2. So this is what we call the CAPM model. You could also use the Gordon's model as well to get this 12.2. If we are given a dividend D1 at 1.43 and the growth rate is 6.6% and the stock is selling for 25.54%, what is the cost of equities in Gordon's model? So D1 is 1.43 over the selling price of stock 25.54 plus 6.6%, we get what? 12.12. So this is using Gordon's model. So you need to master this. So you notice that both methods are given us the same answer, reassuring us that this can give us the same, but it's not always the case in real life, and just for illustration purposes. So remember, there's also an added return, which is the cost of retained earnings. I talked about the urgency. What problem is that? Urgency problem that exists between shareholders and the owners of the business. So there's usually that antagonism where shareholders sometimes feel being exploited because managers want to enrich themselves using returns, you know, and they want to plow back capital other than borrowing. So now here is WACC, where we're going to look at how the the company would want to ensure these retained earnings have a cost. So the question is, do these retained earnings have a cost? Yes, retained earnings have a cost. So let's look at how this cost of the retained earnings is evaluated. Cost of retained earnings. So they belong to the shareholders. It's supposed to be paid as dividends, but these guys decide to use these monies. So the question comes, do cost of retained earnings exist? They do because they belong to the shareholder. So the firm keeps them, and shareholders will lose the chance of what? Investing that money elsewhere. So the cost of retained earnings is actually the opportunity cost that is foregone in terms of dividends. So it's equal to the cost of equity. So because the shareholders could have earned that in terms of dividends and use it elsewhere, we attach it to our cost of equity. Now here comes now the argumented costs. When we put together, we come up with a big one, which we call the weighted cost of capital, WACC. So WACC now is what we're going to look at when we put them together. What is WACC? Weighted average cost of capital. This is the average return a company expects to compensate all its different investors. So when a company is given a target of the capital structure, it uses different forms. They are all computed together to come up with what is called the weighted cost of capital. So the average weighted cost of capital is the cost that company must pay all these investors, weighted by how much they use. So it is a weight of what? Equity times cost of equity, weight of preferred stock times its cost, and debt times this cost. Of course, you take into consideration the um, tax shield. So let's look at an example here. Work formula. So it's given by this formula here. And the weight of equity, cost of equity, weight of preferred stock, cost of preferred stock. Although sometimes you just be given two forms or these two forms, so you need to know the weight of debt times the cost of debt and as a tax shield. So here is an example that we can look. So we are given a company with the following structures. So long-term debt is 3 million, preferred stock 1 million, common stock is what? 6 million. So when you total this is 10 million. So what is the weight? It's just a proportion of debt. 3 over 10 is 30%. Weight of preferred stock, 1 over 10 is 10%, 6 over 10 is 60%. The aggregate is what? 100%. So now we continue from that example where we had our cost of debt as 10%, suppose cost of preferred stock 12%, and the tax is 40%, and here the cost of equity is 12.12%. So we're asked to calculate what? WACC. So using the formula above, the cost of um, equity was how much? 60%. So cost of equity 60% times the cost of the weight of equity 60% times the cost of equity 12.2. Then go to the weight of preferred stock was 10%, which is 0.1 times 12% here. The weight of debt was 30% times the 10% cost of debt, then 1 minus a tax shield, which is 40%. So the overall of what we get becomes 10.32. 10.32. So work has its own limitations. The major advantage is for simplicity's sake when you're evaluating projects. So the same rate can be used for all projects, and this will obviate all individual projects. The main limitation is that it doesn't take consideration of what is called the flotation cost. Okay, so what has advantages is that it's very useful, but it's not a perfect way. It is simple for all projects. It saves time. There's no need to calculate different costs for every project. The limitation is that it ignores what? The flotation costs. These are fees for issuing these new securities. They're called flotation costs. It also assumes that there's the same capital mix for every project, which is not usually realistic. Therefore, using same work is risky. It can lead to bad decisions. Now, what influences work? What influences work? And what are these flotation costs? So, factors that influence work, they usually come at the end. Sometimes they'll ask you, number one, the market conditions. So, interest rates and tax rates will affect your work. Number two, the firm's capital structure. So, if you have more debt, generally, it will lower your work because of that tax shield. But too much debt is also risky. Also, what also affects work is the dividend policy. The dividend policy will affect what? The retained earnings and also will retain the cost of equity. Also, the investment policy. So, riskier projects um, um, mean the work will be higher. Then more detail on the flotation costs. So when a company raises new capital, it has to pay what are called investor fees to these investment bankers. So these are called flotation costs. So this is usually done when you are starting up a new business. So when you want to raise new capital, this will be paid to bankers. So the services will include you having setting the price, selling issue, printing certificates, underwriting, government fees. Okay. So it's important to know that flotation costs are the highest costs for common equity. However, since most firms don't issue equity very often, so this is per project cost, which becomes small. That's why we ignore these flotation costs when we're calculating work because they come just at that particular moment. So now, what is the implication of minimizing work? Okay, when we minimize work, we minimize the value of when we minimize work, we are minimizing the value of firm. So since work is the weighted average cost of debt and equity, so when we lower work, we're increasing the proportion of cheaper capital, which is debt. So we need to be careful. So too much debt also increases the financial risk and may eventually raise the cost of equity and debt. So our goal here is to find an optimal structure or mix that will minimize work. Um, why do we want to minimize work? Because the lower work will increase the value of the firm and profitability. And also remember that there's a tax shield, which is critical. And this is what makes debt cheaper than equity. So we can look at an example before we move anywhere further. Any questions there? Any questions? We'll look at the question on work. Any questions? Do we have any questions?
No.
Okay, so let's look at this question here. Question number 3. Stock road pave has a beta of 0.85. Market risk premium is 8%, and the Bank of Zambia has announced treasury bills are currently yielding 5%. The most recent dividend was 1.60, and dividends are expected to grow at an annual rate of 6% continually. If the stock sells for the 7 a quarter per share, what is your best estimate of the company's cost of equity using both Gordon's and CAPM model? 15 marks. This is a very sweet question. So what are we given here? Advise to buy this pamphlet. And most people are looking for the most recent questions or the old questions that I compiled are usually the best because that's where I get most of the questions. So what are we given?
The beta,
Beta
85.
0.85. What else are we given?
The market risk premium, 8%.
Okay. I'd explain to you that market risk premium is what? This is very important to remember because some people will be looking for it in the formula. Uh-huh. So beta, this one is um 0 point. Then the premium, 8%, is the difference between the um, market return minus what? Risk-free rate. That one, what is found in the brackets? Remember the formula for the Gordon's, the Kaplan model, right? What is the formula for Kaplan model? I'm calculating our cost of equity. KE is equal to what? We looked at the two models. Who remembers the Kaplan model? KE is equal to what?
Is it the one for the risk-free
Yes,
plus the ERM minus risk-free multiplied by beta?
yes. So the valuation of equity, we looked at the two methods. There is the Kaplan model, which is given by KE is equal to what? Um, Risk-free rate plus the expected market return minus risk-free rate times beta. So this sometimes is given alone. This is called the risk premium. So you replace this entire part. Then the risk-free rate that we know usually is what? The treasury bills. I'll just say treasury bills, or so that's called the risk-free rate. Are we together? So let's go back to identifying what we have now. Okay, so our cost of equity is equal to risk-free rate plus what? Beta times what? Risk premium. So what are we given as our risk-free rate? 5%, which are treasury bills. And our risk premium is what? 8%. Okay, so what do we have here? 5% plus beta of 0.85 times what? The risk premium is what? 8%. What do we get? Okay, so we're being asked to calculate the cost of equities in the Gordon's model and using our Kaplan model. So what are we getting here using the Kaplan model?
11.8,
What are we getting?
11.8%.
11.8%. Correct. Then we use now the Gordon's model. What is the form of the Gordon's model? What is the formula for the Gordon's model? D1 over P plus growth. This is what we call the Gordon's model, right? Only two valuations. So let's go now to the parameters of the data that we've been given in terms of Gordon's model. Okay. So we're told that the company's most recent dividend is what? 1.60 per share. So this is our D1 or D0?
Is zero.
Yes, D0, correct. And let's just say the A1, A later. So this is our D0. What else are we given? and it's expected to grow at 6%. Uh-huh. So this is our growth, our G. And if the stock sells for 35 kwacha per share, so what is this? Our P0. Okay. Okay, so we don't have D1, but we learned in our previous class how to calculate D1. Who remembers how to calculate D1? Because here we have D1 showing there. Who remembers? How can we manipulate this formula?
D1 equals to D0, open brackets, 1 plus G.
Excellent. So meaning that is a walkover issue, right? So we can manipulate that as KE is equal to what? D0, 1 plus G, over what? 1 plus G over what? Just follow the way it is. You're just replacing the D1 by 1 D01. So here where there's D1, just put D01 plus G over P O plus growth. Okay. So what is our D0 there? We're going to put 1 point what? 60. Then 1 plus growth. Our growth rate is what? What is our G? 6%. 1.06 over P0, which is what? 37 plus what? The growth of 6%, so 0.06. What are you getting? You're getting ultimately, so 1.60 times 1.106 over 37. What are we getting?
Getting
That's the
10.58%
final answer,
as the final answer.
10.58. So which one is the better? 58. One is 11 point. So calculate both of them. And what's your best estimate? Okay, the Kappa model is giving you the best estimate. The higher, the better. Are we together? Okay, so we end here. You need to do this as your homework. Do what I've done. Do both of them, in fact. And I'll need a company as this. A company has a price per share of 25 and just announced it wants to buy ABC Limited for that 5 kwacha per share to acquire the outstanding stock. ABC's management immediately begins fighting off hostile bid. Is management acting in the shareholders' best interest? If not, why? So remember this is what I was always talking about, the theoretical arguments. This lecture is always particular. Okay, so I expect you to argue those facts based on what I've been talking about in the class. All right. Are we together? Are we clear?
Yes.
Okay. So we end here. Our next class will be on risk and return.